It wasn't a glitch in the banking software, it wasn't a rogue decision by a panicked CEO. It wasn't even a mistake by the regulators, it was the intended function of the system. The mechanism is already written into the law. The framework was signed years ago. The trigger is the only missing variable. Most people view their bank account as a digital vault. They believe the number on the screen represents money they own. They believe it sits there static and safe, waiting for a withdrawal. This is the fundamental illusion of modern finance. The moment you deposit currency, you no longer own it. You become an unsecured creditor. You are lending money to a highly leveraged institution. In exchange, you receive an IOU, a promise to pay nothing more. For decades, that promise was backed by the perceived solvency of the state, but the arithmetic has changed the debt. Loads have crossed the event horizon. The collateral backing the system is deteriorating, and the safety net has been quietly removed. In 2014, the rules of the game were rewritten. The era of the bailout ended. The era of the bail-in began. The difference is not semantic. It is the difference between taxpayer money saving a bank and your money saving a bank. The plan is global. The legislation is harmonized across the G20. The target date for full implementation of the final capital requirements aligns with the 2026 horizon. The summit risk is not just the reserves, it is the $18 trillion in deposits sitting in the United States commercial banking system. The pattern is unmistakable, the incentive is clear, the legal architecture is complete. Major dramatic pause. To understand the gravity of the 2026 horizon, we must first dismantle the comforting myth that legal ownership of money is absolute. History is a graveyard of absolute property rights that evaporated the moment sovereign solvency came under threat. The assumption that a government or a central bank will protect individual savings at the expense of the systemic whole is contradicted by every major financial crisis of the last century. The state's primary directive is self-preservation when the choice is presented between the collapse of the sovereign bond market and the seizure of private capital. The state will always choose the latter. This is not a conspiracy. It is a hierarchy of survival. We are not dealing with a hypothetical scenario. We are dealing with a recurring historical mechanism known as financial repression, which often culminates in direct confiscation. The framework for the next confiscation has been meticulously constructed under the guise of financial stability. The term used in the technical literature is bail-in. It sounds technical, almost benign, suggesting a responsible internal fix rather than an external rescue. In reality, it is the statutory authorization for a bank to convert its liabilities, your deposits, into equity to recapitalize itself during a failure. This means that if a bank fails, your checking account balance is not paid out to you. It is forcibly used to buy stock in the failed bank. You go from being a depositor with access to cash to a shareholder in a bankrupt institution. This structure was solidified following the 2008 financial crisis. During 2008, the public outcry against using taxpayer funds to rescue Wall Street was deafening. The political capital for another taxpayer-funded bailout does not exist. The regulators know this, the central bankers know this. Therefore, they constructed a new mechanism where the creditors of the bank pay for the rescue, and because depositors are legally unsecured creditors, they are on the hook. The G20 summit in Brisbane in November 2014 was the turning point. Leaders of the world's 20 largest economies endorsed the proposals by the Financial Stability Board to ensure that too big to fail banks had sufficient loss-absorbing capacity. That capacity is, let us look at the historical precedents because they show us that these powers are never theoretical, they are always used when the mathematics of debt becomes unsustainable. The most striking example of direct seizure in the modern era occurred in Cyprus in 2013. This is the template, this is the case study that every central banker studied. In early 2013, the Cypriot banking sector had become insolvent due to exposure to Greek government debt. The European Central Bank and the IMF, the Troika, refused to provide a full bailout. They demanded a contribution from the depositors. On the morning of Saturday, March 16, 2013, Cypriots woke up to a new reality. The banks were closed, online transfers were disabled, ATMs ran dry. A one-time stability levy was announced. Initially, the proposal was to take 675% from insured deposits under €100,000 and 99% from amounts above that. The public reaction was immediate fury, but the die was cast. While the terms were slightly adjusted over the following chaotic days, the final outcome for depositors at the Bank of Cyprus and Laiki Bank was devastating. Uninsured depositors, those with more than €100,000, saw 475% of their savings converted into equity. The equity was effectively worthless. The remaining funds were frozen and released only in small increments over a period of years. We can categorize the risks we face into three distinct bands. The low-risk band involves the failure of regional banks, similar to what we saw in early 2023 with Silicon Valley Bank and First Republic. In these cases, the system might still have enough political will to cover uninsured depositors, to prevent contagion using the systemic risk exception, but this creates a moral hazard that makes the eventual crash larger. The medium-risk band involves a systemic freeze. This is the 1933 scenario. A bank holiday is declared. Withdrawals are capped at $500 or $1,000 per day. Digital transfers are restricted. This stops the run but freezes the economy. The high-risk band is the full statutory bail-in. This occurs when a global systemically important bank, GSIB, faces insolvency. The numbers here are too large for the FDIC insurance fund, which holds less than 2% of the insured deposits. It covers. In this scenario, the bail-in triggers automatically. A portion of deposits is converted to equity. The bank opens on Monday morning under new ownership. But the stock you own is plummeting and your liquid cash is gone. This is the scenario for which the $18 trillion figure becomes relevant, as it represents the scale of deposits that are technically unsecured. Loans to the banking sector. There is a counter-argument often raised by mainstream economists. They argue that the government would never allow a bail-in of depositors because it would destroy faith in the currency and lead to immediate political revolution. They argue that the Federal Reserve would simply print the money to cover the deposits, choosing inflation over confiscation. This argument assumes that the government fears the voter more than it fears the bond market. This is a miscalculation. The rebuttal lies in the incentives. If the Federal Reserve prints $10 trillion to bail out depositors, the currency collapses immediately. Hyperinflation destroys the state's power, its military capacity, and the wealth of the elite. A bail-in, however, is targeted. It hurts the savers, the middle class, and the businesses, but it preserves the currency unit and the sovereign bond market it sacrifices the few, or the middle, to save the structure of the state. When faced with the choice between hyperinflationary collapse and a structured default on depositors, the state will choose the structured default. The bail-in is the rational move for a sovereign that wants to survive. The endgame follows a fixed order. We are currently in the phase of controlled decline. This is characterized by negative real interest rates, where inflation is higher than the interest you earn. This is a slow-motion confiscation of purchasing power. It is designed to erode the real value of the debt. The banks are kept alive by regulatory forbearance, hiding their losses on commercial real estate and duration risk. This phase can last for years, but it requires the public to remain passive and unaware. The next phase is chaotic collapse. This is triggered when the slow bleed is no longer sufficient to cover the gaps. A shock to the system, a war, a pandemic, a foreign sovereign default exposes the insolvency of a major player. Liquidity evaporates, the interbank lending market freezes. This is the moment the bank holiday is declared. This is the moment the apps stop working. The chaos is necessary to justify the draconian measures that follow. The final phase is reset and restructure. This is where the 2026 timeline becomes most poignant. The solution presented will likely involve the introduction of central bank digital currencies, CBDCs. The argument will be that the commercial banking system is too risky and antiquated to protect depositors. The central bank will offer direct accounts or digital wallets that are liability-free. But to move your money from the frozen commercial bank to the new secure CBDC, you may have to accept a haircut or conversion rate. The bail-in clears the bad debt. The CBDC locks down the new system. The transition is complete. The historical record is clear. The legal framework is in place. The economic arithmetic makes the outcome inevitable. The only variable is timing and pain. Subscribe to this channel. Preparation is not about predicting the exact Tuesday the banks close. It is about building resilience that does not rely on a single point of failure. It is about understanding that in a debt-based monetary system, you do not own what you cannot hold. Diversify your custody. Understand the difference between a secured asset and an unsecured promise. Watch the data, not the headlines. The pattern is unmistakable. Would you like me to generate a description for a high CTR style thumbnail to match this script?